To discuss the Fed and the U.S. economy, we're joined by Peter Schiff. Peter is the CEO of Euro-Pacific Capital and host of the Peter Schiff Show. Now, my question is, Federal Reserve Chair Janet Yellen spoke before the Senate yesterday about Fed policy. So what stood out for you, Peter, in her remarks?
Well, I think the most important aspect was in her prepared statement, where she read the text that they had carefully, scripted. And she said that at some point in the future, the Fed is going to have to begin thinking about raising interest rates. And I think that's very interesting, because she didn't say at some point in the future we're going to raise rates. All she said is they're going to start to think about raising rates, which makes you think, well, what have they been thinking about all this time? And they haven't even begun to think about raising rates. So, look, the Fed has no intention of raising rates. If they did, they'd have been thinking about doing it for years. Instead, all they're doing is talking about raising interest rates because they don't want to admit that they can't, because they'll prick the very bubble that they spent so much time inflating.
Peter, were you at all surprised by her negative comments on the audit the Fed movement?
No, not at all. I mean, why would the Fed want to be audited? And, the irony of it is, and I think one of the congressmen today actually pointed this out, because Yellen says, look, we don't want to politicize the Fed, when, of course, the Fed is totally politicized right now. But normally, the reason that you don't want to have politics involved with the Fed is because there will be pressure for the Fed to print a lot of money, monetize government debt, try to artificially stimulate the economy to help politicians get elected. Well, that's exactly what the Fed is doing right now. And all the criticism coming from the Republicans is that the Fed is too easy, that the Fed has to stop printing money, that they have to raise interest rates, stop quantitative easing. So what the Congress is actually trying to do is rein in a recklessly political Fed that is trying to reelect incumbents. So we're not getting any independence from the Fed. That's the reason we need some congressional accountability and an audit, because the Federal Reserve is acting in a highly political manner. Meanwhile, they're trying to pretend the reason that we can't audit them is because they don't want to be politicized. I mean, it's completely ridiculous.
Now, based on what Yellen told Congress, do you still think there is little chance of a hike? And can you give us some context here?
Well, not despite what she told Congress. That's what she told Congress. She said that, number one, as long as the word patient is there, that they're not going to raise rates. So patient is still there. And then she said, before we raise rates, we're going to take out the word patient. But if we take it out, don't assume that it means we're going to raise them. She said if they take out the word patience, all it means is that the Fed might begin to think about raising rates. They're going to begin a process of thinking. And we have no idea how long the process is going to last. Look, I don't understand why so many people still believe that they're going to raise rates, given what the Fed is saying.
So what about the U.S. economy? Does it support the all-time high in shares that we've seen?
No, it's the Fed that supports the all-time high in shares. It's irrational exuberance. It's cheap money. Look, the economy is not strong. We have a bubble, and it can't exist without the Fed's constant supply of air. In fact, I think that just not doing QE4 is enough to deflate this bubble, let alone raising interest rates. So I think we're going to get QE4. And, ultimately, for the people who believe the Fed, if people think the Fed's going to be raising rates, they should be selling stocks. Because if the Fed actually were to tighten and to shrink its balance sheet, the stock market would get clobbered. The only reason I don't think the stock market is going to be destroyed, 50% down or more, is because I don't believe that the Fed is going to embark on a tightening campaign. It's because I'm confident they're going to do QE4. That's the only reason I'm not more negative on the market than I am. But it is extremely overvalued, just the way it was in 1999, 2000, or 2008. It is very dangerous to be buying U.S. stocks, but it's also very dangerous to own U.S. currency. So I don't think people should just sit on the sidelines in dollars. They do have to invest. I just think it makes much more sense to look beyond the United States selectively at the countries that are in much better shape, especially now that you've had a substantial decline in most currencies relative to the dollar because of the false belief that the Fed will be raising rates because we have a legitimate recovery. When people realize it's a bubble and that the Fed's going to blow in more air, you're going to see a big drop in the dollar, which is going to be very beneficial for people who have invested outside the United States.
And how about globally? What are you seeing as places to avoid and places to buy?
Well, there's still a lot of problems in Europe. And so you have to be careful about where you invest there. You know, not all the emerging markets are the same. I mean, there are problems all around the world. It's all about avoiding those pitfalls, you know, avoiding the landmines while you're trying to find the gold mines. And, of course, many of the gold mines are literally gold mines. But, you know, there's plenty of opportunities outside that sector. But in general, I look at countries that have fewer regulations, lower taxes. Countries like Singapore, Hong Kong, New Zealand, Switzerland are just a few. And, you know, those countries right now are undermining their own currencies. They're deliberately keeping interest rates low to try to create inflation because they don't want their currencies to go up. It's kind of like, you know, they're the smart kids in the class, but they don't want to get a good grade because they don't want to screw up the curve for all the dumb kids. So they're deliberately, dumbing down their own scores.
I like that. They don't want to mess up the curve for the dumb kids. But I want to ask you, what sectors of the U.S. financial markets look attractive to you right now?
Well, I don't think anything looks attractive in the U.S. market, but, you know, certain things look less attractive. I mean, and, you know, I don't want to be in the bond market. I mean, there's a big bubble there. I don't think you want to be in the retailers or the home builders or the financials. And certainly there's a lot of social media type companies, you know, companies that have no earnings or no prospect of earnings, and they're trading on hype and hope. So, you know, I think some of the, you know, the multinationals, maybe they're going to go down because they're going to have some earnings problems because of the stronger dollar. But because I think the strong dollar is going to be short-lived, there may be some opportunities as some of these stocks come down based on weaker earnings. But so far, a lot of them haven't come down. I mean, you know, people are still buying these stocks. You know, they're not even paying attention to the earnings outlook.
Peter, I want to talk to you a bit about manipulation. Now, Hewlett-Packard reported horrible numbers that saw a declining top line in their core businesses, and shares fell on the news. However, the interesting bit is that at the same time, HP has sacked 44,000 workers and expects that total to rise to 58,000 by the end of fiscal year 2015. Yet, it's buying back shares. So why would HP buy its own shares when its businesses are falling apart, it's firing employees by the tens of thousands, and its stock price is declining? I mean, what am I missing here, Peter?
Well, one of the reasons they're probably firing workers is so they can use the money that they would have paid in salary to finance these share buybacks. And, of course, a lot of the money that is going to finance the share buybacks is not going into legitimate capital investment, which means they're not going to need their workers anyway because they're squandering the money they should be spending on plant and equipment on buying back their overvalued stock. But this is the game Wall Street is playing. Lever up, lay people off, and use the savings to buy back your own stock so that you can, you know, create higher stock prices so the executives who are compensated with stock options can cash out and make a lot of money. Look, this market is an accident waiting to happen. The Fed knows that. That's another reason why the Fed doesn't want to raise rates, is they don't want to prick the stock market bubble.
That was Peter Schiff, CEO of Euro Pacific Capital. Time now for a very quick break, but stick around because when we return, George Magnus will be on the show. George and I talked about Euroland and the major economic themes in the UK ahead of elections over there. And